Hi, everyone. My name is Zach Gast. I'm the head of Global Research and Analytics with CFRA. I'd like to welcome everyone to today's webinar on Apple, upcoming product launches and supply chain beneficiaries. Over the next hour, my colleague Angela Zeno will review CFRA's bottoms-up research approach on Apple and how we evaluate the underlying variables that influence the performance of companies. Before we get started, I wanted to remind you that today's session is being recorded, and a link to the recording will be made available within the next few business days. During today's session, you may submit questions using the GoToWebinar chat function, and we will do our very best to answer as many of those questions as we can towards the end. During today's session, Angela will detail our expectations of new products set to be unveiled by Apple at its all-important annual September event, and what this may mean for investors. This includes forecasts on the potential new device launches, our expectations on the winners and losers within the Apple supply chain over the next 12 months or so, and the investment outlook on Apple, as well as top recommended ideas within the semiconductor supply chain. For those of you that may not be familiar with CFRA, our mission is to provide the world's best independent and actionable research and analytics for investors. Our equity coverage analysis blends both fundamental equity and forensic accounting methodologies to produce the best research for the wealth management space, while our forensic accounting team focuses on deep analysis of a smaller set of companies for a range of audiences. We carry out that mission with a team of more than 75 analysts globally that apply their expertise to fundamental, forensic accounting, legal, mutual fund and ETF, and strategic domains. Our focus is on bringing those skills to bear to ensure that we're generating the highest level of investment performance for our clients across more than 1,500 companies and more than 20,000 funds globally. For our equity coverage team, we produce stock reports, industry surveys, and thematic research for our client base to pull from. This work has been featured in our thematic reports over the last month. So if you haven't checked out the thematic research on MarketScope Advisor, please take the time to do so. There's a ton of great content there, and it's definitely worth your time. With that, I'll hand it off to Angelo and let him get started. Angelo?
All right, thanks, Zach, and thanks for all of those on the call today. Many of you may know that the biggest day for Apple investors every year comes in September when they unveil their next generation of products. And we believe this year will actually be a very exciting one, as Apple likely has more product announcements coming this fall than it has ever had in its history. Now, it's no guarantee that the products I plan to highlight will necessarily be announced at the September event, but we do expect all these products to be unveiled at some point this fall, and I'll break that down for you here over the next few minutes. So as is always the case this time of year, we expect iPhones to really headline the event. So once again, all about iPhones, iPhones, iPhones. First, some key dates to keep in mind. The product unveiling has been confirmed for Wednesday, September 12th. We estimate that pre-orders will likely start at this point on September 4th from Apple and carriers, with actual shipments likely beginning on September 24th, and that's really where revenue recognition for Apple will start as well for these devices. In terms of iPhones, we expect 3 new devices, and you can see the details in the table provided here. As far as product names are concerned, it's really a complete guess on our end. Who really knows what Apple is going to go with? But that being said, starting with the iPhone XS, which is that middle product, it's the successor to that high-priced iPhone X that's currently on the market right now. Expect this to be very similar in nature. It's going to have a beautiful 5.inch OLED screen, edge-to-edge displays, and facial ID AR capabilities. Facial ID really is the ability to unlock your phone with your face for security reasons and convenience. You'll also hear me talk a lot about AR, or augmented reality, on this call, as Apple's really pushing its next wave of devices to this new capability as they look to really transform their user interface. So what I'll do is maybe take a minute to actually define what AR is, as it's probably a new term for many of you. So really, augmented reality is where objects that reside in the real world are augmented to enhance the user's real world experience. So probably best explained via an example. The most popular one you hear about today is being able to go, let's say, shopping for a couch and having that furniture sitting in your living room before committing to buying it, so being able to visually see it. But that being said, in terms of that iPhone XS, the only real upgrades you're going to see are going to be internal in nature, as it'll come with a faster A12 processor, expected to improve the iPhone performance and battery life, as well as a faster LTE modem. Overall, the aesthetics of the device will remain exactly the same. The device may also come with Apple Pencil support for those that are interested. As far as pricing is concerned, we expect Apple to be more aggressive on this phone and drop the price by $100 for the iPhone XS to $899 from $999 currently. This largely reflects our view that Apple has been able to sharply cut component costs, things like OLED display prices as well as memory prices, and we expect that will push the lower cost to the consumer. Now, given the lower pricing point, we think Apple likely discontinues the older iPhone X model that's in the market today, rather than dropping the price by $100, which it has historically done. For instance, think about the iPhone 8 today, was rolled out a year ago. The iPhone 7, therefore, was dropped by $100. We don't think that's going to happen with the iPhone X here. Makes sense, too, given our view that the iPhone XS probably is priced $100 cheaper. Second, in order the next device we expect Apple will unveil is a new larger screen version of the iPhone XS. So a 6.5-inch OLED screen with essentially all the same capabilities of that smaller iPhone XS. Now, given the larger size of this device, we expect the price point to be $100 higher than the iPhone XS. And this was a product that was really missing when the iPhone X launched last year, and something we believe consumers were really craving. And then finally, the third and probably most anticipated device coming out this fall is what we're calling the iPhone X. Apple can easily call it something else, the iPhone X SE or whatever. This will be Apple's low-cost device with some stripped-down capabilities to get to that price point. But the price point and features are primarily intended to gravitate to the China consumer, as well as other emerging regions. So in terms of key features, we expect them to have a massive 6.1-inch LCD display, which would be Apple's largest screened LCD device ever. It'll also come with a true depth camera system for that facial ID, AR support, and edge-to-edge displays. Other additions include that more powerful A12 processor, the faster modem, like the other two devices I highlighted. From a stripped-down capability side of things, we expect to keep that price low. We expect them to have more of a single lens rear camera, as well as an aluminum body rather than a glass backing, which probably means no wireless charging on this device. And that's really a step back, as last year Apple moved to a glass substrate to have wireless charging in all their devices. We also don't expect a 3D touch capability, and I'll go through that later on. But that being said, to appeal to China consumers, we do expect more color options, like a red, orange, among other colors, and it'll come at that low price, at least for Apple's sake, at $699. So in addition to iPhones, we expect Apple to also have a lot more slated to unveil, and we highlight those in this table. First, an Apple Watch update to us is a no-brainer, as they've announced at this same event the last 2 years alongside the iPhones. You're finally we think, going to get a change to the aesthetics of the Apple Watch after 4 years, and that's going to come via a larger screen driven by a bezel-free design. It'll make this screen, we think, about 15% bigger than prior versions. Also, you'll get better sensors, specifically heart tracking related, as you get that in every new upgrade cycle. We believe the design change alone should be enough to really drive higher Apple Watch sales here. And we're already forecasting Apple Watch sales to double here in 2018, largely because of their move to a cellular service last year. Overall prices we expect to remain unchanged for the Apple Watch. Next, you have AirPods. This is we think this is going to be the first upgrade since the original release came out 2 years ago. Overall, expect minor updates here, largely going to be that Hey Siri capability. So, in the past you would have to activate Siri with double tapping the actual AirPods. With this capability, you're not going to have to do that. We see the possibility of noise cancellation features, but that's more of a 2019 update in our view. Overall, pricing on this device also remains unchanged. On iPads, we anticipate updates to both the iPad Pros. The iPad Pros are the devices Tim Cook has envisioned in the past of being kind of the replacement to PCs, not necessarily the case. But these tablets, we think, will take over many of the same features that you see with the iPhone 10 currently. Both will have the bezel-free design, but will have that bezel-free design will have different implications to each device. So on a 10.5-inch iPad, the edge-to-edge display will actually increase the display size to 11 inches. For the 12.9-inch iPad Pro, we expect the edge-to-edge feature to actually reduce the overall size of the device, but keep the display size at 12.9 inches. Other features you'll see on both include that Facial ID, AR capabilities, as well as the removal of that home button. Again, similar to what you're getting with the iPhone 10 on the market today. Then on Macs, we expect a new low-cost device, much unknown here, and we really don't want to guess on what's going to happen with the Mac, but we do expect a new device priced under $1,000 to help gravitate to a lot of the students in universities. And just an FYI, we fully expect Apple to unveil new iPads and a Mac this fall, but it's really, it is entirely possible that they do this at another media event in October or November, so that they give iPhones and wearables their kind of full attention that's due next week. And finally, you have AirPower, which is Apple's wireless charging pad. This was actually announced at Apple's event last year, but due to production issues, we still haven't seen an actual launch. We do believe that those technical issues have been largely resolved and will begin shipments sometime this month. Makes complete sense to actually wait for these new devices that should help capture additional demand, we think, with the AirPower. We give overall a pretty wide starting point for AirPower, between $100 and $200. At this point, we really don't know what Apple's plan is. So now that you all kind of know what I know in terms of what we expect Apple to announce next week, I'll walk through what our outlook is for these devices and implications we think it'll have on Apple. So here is a chart of every iPhone cycle announced over the last 8 years. As you can see, the last major iPhone upgrade cycle, that is, took place with the launch of the iPhone 6 back in late 2014. In fact, if you actually look, every cycle since the iPhone 6 has actually seen shipments below that cycle. Now, given the scenario, we continue to conservatively forecast no shipment growth for iPhones through September 2020. And that date is no coincidence, as that's when we actually are tentatively forecasting a 5G iPhone to be unveiled. However, we do see upside to our unit volume expectations for the upcoming iPhone cycle, and I'll provide more on that in a minute. So why virtually our no growth assumption here? Largely reflects the fact that innovation has really been largely unimpressive, but more importantly, replacement cycles are slowing down because consumers have a device that has been paid off. So for example, about 51% of consumers with a Verizon data plan have a phone that's been paid off. So the consumer is in no rush now to upgrade and pay more on a monthly basis. So, we're talking about replacement levels now approaching 3 years, whereas 4 to 5 years ago, the replacement cycle was about 2 years. Also important to point out that demand for Apple's iPhones via third-party platforms, whether it be eBay or Amazon, has been very strong, especially in emerging regions, which is, in some respect good because it's helping to support a growing installed base for Apple. So what's our outlook on iPhones? When you look at the chart on the bottom left, it illustrates annual iPhone shipments, which is that blue bar. As you can see, this year, as well as for the next cycle, will be relatively flat to prior cycles, and again, below that peak that we saw in 2015. Now, the chart on the bottom right depicts a different story, as revenue this year and through 2020 will eclipse that peak seen in 2015. So why is that? Well, it's of course because of Apple's strategy to shift to the higher priced devices by offering consumers more great content. So for instance, the current cycle, which is about to end, average selling prices were up about 15% from the prior cycle. And that primarily reflects easy comparisons, as it includes that $1,000 device that wasn't included in prior cycles. As we anniversary this cycle, those growth numbers are, of course, going to be unsustainable. Now, as we approach this next cycle, product mix will be crucial for Apple. Once again, we like to be conservative and estimate a bulk of the shipments to come from the lower priced LCD device. In fact, we're looking for about 55% of shipments to come from that one phone. We think the second most popular product will be that higher priced iPhone XS Plus. So think of consumers almost taking that barbell strategy, either going to the extreme on the low end or the high end. Importantly, as we expect the Plus version to be the same price as the iPhone X is currently, we do expect this device to be very popular, specifically in the US. All in all, the favorable product mix leads, in our view, an average ASP assumption being roughly flat to up 2%, even as the comparables for the next two cycles will be much more challenging. So now, before I go into some of the supply chain dynamics, just here's a quick, broader snapshot of where we think the strength of Apple will come from in the coming years. So Apple's historically core business, that being iPhones, iPads, and Macs, last year made up about 81% of sales. These same products we expect to drop to 72% of sales by 2020. That doesn't sound like much diversification, but when we look at the bottom line, we think profits outside of these core products start contributing towards 35 to 40% of sales, or towards 35 to 40% of profits by 2020. Looking more near term, we do think investors are underestimating the upside potential for these core products. Again, iPhones, iPads, and Macs, especially in the December quarter, should we indeed see the product refreshes that I highlighted earlier on the call. So for instance, we project iPads currently to decline in the December quarter, but should we see that refresh, just a retail inventory build itself likely gets you to double-digit year-over-year growth for iPads and adds another point to growth. And that may not seem like a lot, but when you're at the scale that Apple is at, every point of growth really counts and goes a long way, at least we think. I think it's also important to note that the iPhone X didn't launch until November of last year due to some production issues. So this time around, we really see no major production issues taking place, specifically on those higher priced devices, which could provide upside to ours as well as the street ASP as well as shipment outlook for that all-important December quarter. Now, on the services and wearable side, we're looking for a 20% plus growth in both areas in each of the next 3 years. Wearables, of course, being driven by watches. We think doubling this year and being north of a $10 billion product. In fact, the Apple Watch will be by far the biggest watch company in the world, while services will continue to benefit from new offerings, such as a video streaming service, as well as just an overall greater installed base. So that really wraps it up in terms of some of the higher level thoughts on Apple, and I'm more than happy to provide some deeper thoughts if there are any questions at the end of this webinar. But that being said, I want to shift the discussion now to the supply chain, and you absolutely have some interesting implications when taking shape on that front. So here's a list of some of the key Apple suppliers within our coverage universe. Really, there are, of course, many, many more. Truth be told, almost all the chip makers within our coverage universe has some exposure to Apple, as Apple is the most important customer in the chip industry and consumes about 8 to 9% of total global semiconductor demand. I highlight the biggest winners here being Cirrus Logic, Intel, Qorvo, and Taiwan Semiconductor within our coverage universe, while the biggest losers are Analog Devices, Broadcom, Qualcomm, and a number of the memory providers. And I'll dig a bit deeper on why I feel this case over the next few slides. But I think it's important and to be mindful that the winners and losers don't necessarily line up with our recommendations here. So, for instance, Qualcomm is a share loser, but we recently upgraded that stock to a buy. But I'll dig a bit more into our recommendations in the next portion of our call. So starting with Intel, they're an obvious winner. Intel was first added as a supplier to Apple smartphones when the iPhone 7 launched about 2 years ago. At that point, we think they entered with about a 20 to 30% market share within the Apple iPhones. That grew to about 50% with the iPhone 8 and iPhone 10 launch last year. We now believe Intel will take up 100% or all of the LTE modems orders for the iPhone models anticipated to be released this fall, whereas 3 months ago we assumed about a 70% share. And that was largely due to some production yield issues going on at Intel. However, we think Apple is now comfortable enough with production of Intel's recently launched modems to go with them. The reason Intel was actually able to take this away from Qualcomm, which there's a loser on the right-hand column, is that this modem is Intel's first that supports a technology called CDMA. And really, I'm not going to go into too much detail about this, but CDMA is a technology that's used by Verizon and Sprint in the U.S. currently. By creating a modem that now supports both that GCM and CDM technologies, Intel's modem chip is essentially compatible with all mobile networks globally. So, when you look at Intel's lower price point versus Qualcomm, that also being a positive for Apple as it looks for ways to reduce their component costs. We think this win probably adds about 1 to 2 points of revenue growth for Intel, but at extremely lower margins. Apple's business probably in the low 40% range versus the corporate average for Intel in a low 60% range. Intel's exposure, we think, to Apple probably increases to about 8% next year. Now, Qualcomm is, of course, the obvious loser here from Intel's win, as Apple de-emphasizes exposure to Qualcomm, partly reflected the heated legal issues going on between the two sides. Now, we don't believe all is lost for Qualcomm, and actually believe it's a positive in the sense that Qualcomm has now de-risked itself from potential lost business, as they essentially won't have any left to lose from Apple. Also, if we do see a mutual legal settlement between the two sides here, and if Intel's chips are vastly inferior to Qualcomm's in terms of performance upon a 5G Apple launch in 2020, it does leave the door open for Qualcomm to eventually come back to Apple. Still, our base case scenario at the moment is Intel wins this business, and also there are also other competitors like a company called MediaTek out in Asia that could also be in the mix to vie for this business. Now, Qorvo is an RF provider. Really think of them as a connectivity provider that makes chips that support the connection between the iPhone and your wireless network. So RF companies like a Qorvo and a Broadcom, a Skyworks is another, have grown in importance over the years as increased data needs have really boosted the demand and content needs for these chips in each individual device. So, to us, commentary back by Qorvo back in February makes us believe that it landed a contract for a highly specialized chip with the content gains to come from we think the lower priced 6.1-inch LCD phone, which we think will be very popular and could boost the annual sales for Qorvo by about 5 to 8% next year, but also be supportive to margins, we think. Now, on the other end, you have Broadcom, which of course loses the business from Qorvo's share gain. However, it won't have, we think, as much of an impact, or at least as much of a negative impact, given Broadcom's larger scale. So we only expect about a 2 to 3% revenue hit. We think this loss could also be easily absorbed via better performance within other business segments and higher overall shipments for iPhones. So that said, we think Broadcom's long-term prospects within iPhones remains very bright, and note that Broadcom was the big winner last year as it saw a host of new chips included in the iPhone, such as the wireless charging capabilities. In fact, I believe Broadcom had content gains of about 40% with the phone launches last year. So every cycle is going to be different. Unfortunately, Broadcom this time around more likely of a share loser than a share winner. Cirrus Logic here, in terms of content, we don't expect much of a change inside the iPhone this year. The big surprise really could come in terms of AirPods for Cirrus Logic. Apple actually unveiled noise cancellation capabilities in the earbuds as we expect Sears would win that business when it becomes available. That said, once again, we think that's more of a 2019 event. And note, though, it still hasn't been reflected in street estimates. More importantly, Sears could benefit more than anyone, we think, from better than expected unit volume as the next generation phones, as revenue from those phones will be more than 70, as Sears Logic is more than 75% exposed to Apple, and by far the most leveraged within our coverage universe. On the winner side also, you have Taiwan Semiconductor. Once again, they're going to be the exclusive provider of the processors for Apple's iPhones. This year it will be dubbed the A12 processor, and more importantly, will utilize Taiwan Semiconductor's next generation 7-nanometer technology, which is just started ramping this year. At the start of the year, Apple was debating whether or not to upgrade to these more powerful chips, but it has, and that bodes well, we think, for Taiwan Semiconductor, and we think it will command better prices for the company. Also important to note, back in July, Taiwan Semiconductor did cut its guidance for the year, but hinted at a better outlook for smartphones, with part of the reason we think likely due to this Apple upgrade. Now, in terms of losers, analog devices, they actually scored a big win 3 years ago when 3D Touch was added to the iPhone 6s. However, we actually don't think it's going to be around much longer. It's believed that Apple has developed a new display construction technology called CGS, which stands for cover glass sensor. So the CGS process separates the touch sensor from the display, and that's a little bit technical, but it's good for Apple as it allows them to reduce the weight and cut costs, but it's incompatible with 3D Touch. So we now expect these displays to be manufactured, at least on the low-cost devices, that being the LCD device, this year, before being totally removed on the 2019 phones later next year. As a result, we assume analog devices declines or sees revenue declines to Apple here in 2019, as well as likely into 2020. Now, memory companies, we think, is also a potential loser, and not your obvious loser, but we expect memory content overall to stay largely the same, with supply in the overall memory market growing significantly. So, except for RAM, which increases slightly, and really not enough to help the likes of companies like Micron, we think that scenario bodes very badly for the memory companies, as the lack of content growth is unable to support some of the supply growth in the industry. The good news for Apple is that they'll be able to contract at lower prices and has been, but again, it'll hurt the memory companies near term. So another important topic I think needs to be brought to light is that we believe Apple's increasing usage of OLED screens in its phones. Remember, it will be in 2 devices, we think, this year versus just the iPhone 10 currently. We think it'll help bring about consumer awareness and thus increase adoption for these screens. Similar, Apple's use of 3D sensing technology that we think will be embedded in all 3 phones, as well as both iPad Pro upgrades this year, will help consumers appreciate features like that facial ID recognition and AR capabilities. Now, on the flexible OLED side of things, we expect strong growth over the next 3 years of about 25 to 30% annually as more competitors start entering the space and help reduce prices. We personally had expected more high-end smartphones to have entered the market at this point, but Chinese manufacturers have remained reluctant to add these screens given the still high price points. It's actually a good thing for Apple, but overall for the industry, not so great. While Samsung still controls, we think, about 90% of the supply to this market, we expect the likes of LG, Sharp, as well as a number of local China players to all begin ramping as early as next year. And that should our expectation really come to fruition here, we do see a good probability that Apple moves to all OLED screens in the fall of 2019. Now, on the 3D sensing side of things, independent research firm Gartner has already projected 40% of smartphones having this capability by 2021. We actually think this number could prove too conservatively. but will be entirely dependent on supply. Apple has really gained a competitive advantage by adopting this technology, and the likes of Samsung and others have had a tough time embedding this in their devices, as Apple has really sucked all the demand out here in the market. But similar to OLEDs, we expect more new entrants in this market, and this will help ease some of the supply constraints and bring broader market adoption. And while CFRA doesn't directly offer STARS recommendations for these 3D sensing companies, companies that would be positively exposed to the growing adoption of 3D sensors would include names like Lumentum Holdings, Finisar, and Viavi Solutions, among others. So now, speaking of STARS coverage, moving on to the final topic, at least on my end today, and maybe the area of most interest to investors, is our recommendations. So what I'll do is first highlight our opinions on some of the key Apple suppliers, and then branch out to some of the supply chain names that we like that aren't as Apple-oriented in nature. So, starting with Analog Devices at the top here, I already spoke. They lost their business from Apple, which will be a headwind, but we believe that's already reflected in the consensus views. In fact, we actually think Analog Devices is a great play on autos and industrials, and has really been outgrowing its peers by about 1.5 to 2 times over the last several years, and we expect that to continue. Overall, they've made a great acquisition on a company called Linear Technology last year. They've been rapidly deleveraging from that acquisition, and we think they're at a point where they're going to start returning significant free cash flow to shareholders. In terms of Broadcom, we think really the hate has gone too far on this name after they announced their intent to acquire CA, which is a software company that's essentially witnessing no growth. And while the acquisition absolutely slows the growth rate of Broadcom, it also significantly enhances the company's gross margin profile, as well as free cash flow potential. The company obviously is being punished for making this acquisition out of left field and not updating investors to explain the strategy. And truthfully, we don't love this transaction, but we expect the company to help provide some color on the deal when they report earnings actually tonight. And we remain confident in the management team based on their past experiences. I would also say that this name is just too cheap to ignore, and trading now, below 10 times on an earnings and free cash flow perspective. Once the synergies are realized on a pro forma basis here. So especially given the company will still be a major beneficiary from the secular drivers going on in the data center space, as well as opportunities presented in available in 5G. We think this is still a great name to own here. Looking at Cirrus Logic, we believe it's a company, again, at a cyclical trough, closely pegged as an Apple supplier as they'll ever get. We see very little risk of Apple wanting to develop these chips in-house, and remain optimistic that Cirrus Logic will be able to expand its offerings to Android customers into mid-low-end smartphone customers next year. At the end of the day, diversification to other hardware customers should provide uplift in the shares, and that's really the crux of our positive call when it comes to this name. Intel, to be honest, this is a name that's going to be hard to work over the next 6 to 9 months, but we still like the long-term story, that being the shift to data centers as well as valuation here. I'll also say that the data center fundamentals remain strong enough where we think Intel will be able to meet its numbers despite losing some market share to AMD over the next year or so. Announcing a new CEO could also act as another positive catalyst for the company. Qorvo, one of our favorite connectivity plays, even in a flat smartphone market, they should be able to witness healthy growth as they capitalize on greater content for their chips in mobile devices. 5G, again, will be a huge play for these guys in terms of content growth, as well as the need to deploy more radio signals across the globe. Qualcomm, been a busy year for them. The U.S. government helped fend off a Broadcom acquisition. They lost out on the acquisition of NXP Semiconductor, and Apple has now completely taken away all its business. So why on earth did we upgrade the stock to a buy earlier this summer after all that was announced? Well, essentially, we don't think there's anything left for them to lose, and there's a lot now that could work out in their favor. It, of course, all starts and ends with a legal battle with Apple. And our legal edge team actually remains optimistic that the two sides, Apple and Qualcomm, will be able to settle it in the coming months. And we believe recent developments, whether it be the recently extended license agreements with its largest customer, Samsung, as well as obtaining revenue from another key supplier, Huawei, we believe that had been holding out, should help support a more positive sentiment for the shares. I would also say a massive buyback in place will also provide some downside support. And note 5G kicks in next year with Qualcomm well ahead of competitors on the technology front. Taiwan Semiconductor, this was a company cut guidance in each of the last 2 quarters. We believe almost all due to cryptocurrency-related issues in the market, but we think Taiwan Semi has now de-risked itself from that exposure. More importantly, its technology lead advantage over competitors we think should set them up very nicely as we get into 2019. And then last one here, Western Digital. This is a company that's dealing with the same issues as Micron and others. It's tough to call when the memory cycle will bottom, but if you're looking for a name that will have a ton of upside once we see that bottom, we think Western Digital is a good play. We think the stock is trading near trough multiples, although it is a risky bet, and would also look at a reduction in estimates potentially as a positive sign for sentiment in the coming months. Because that really is, at this point, we think what the buy side is waiting for before getting back into the name. So now I'll just briefly highlight names that we're recommending in the tech supply chain that are less viewed as an Apple play. If you're a growth investor, we think the best names to be looking at right now are companies like Advanced Micro Devices, Monolithic Power Systems, Mellanox, and Pure Storage. They're by far the best growth stories in our view among the names that we're recommending within the supply chain. And I'll just highlight a couple of them. In terms of Advanced Micro Devices, this has been a name that's been it's been a well-discussed story by the media here, I feel like, over the last month. We upgraded AMD back in January, believing that the second half of this year in 2019 would be the key as they gained significant traction for the EPYC servers in the data center. And we think that's actually now starting to happen at the expense of Intel. 2019 will really be the biggest story for AMD as its next generation chips actually see better performance over Intel's, which with Intel currently working on some manufacturing delays going on. When you look at Mellanox, they make the connectors that go into the data center, and then you think about Pure Storage, they're an all-flash player in the data center, which will start to benefit from some lower commodity prices. We think both are great opportunities to benefit from those secular trends and higher investments going on in the data center. Both companies also have some great new product releases that have been recently announced, and we think the momentum is going to be very strong going into 2019. More of the value-oriented names here, Microchip, one of our top plays, a very similar situation to Broadcom in some respects. We do have a strong buy on it. We think the street has overly punished this name. A lot of this is being due to self-inflicted issues by Microchip itself, but we believe these are all temporary. For instance, they just acquired a company called Microsemi that unfortunately stuffed the channel, and as a result, Microchip will be spending the next 3 to 5 months digesting those mistakes. That said, we think management has historically done a great job in these situations and think the stock at current levels really reflects an enhanced buying opportunity. So I think this is the last slide on my end, and just kind of briefly highlighting our buy on Apple, probably a good way to sum everything up on my end. Again, when we look at Apple, there are really 3 key drivers to our buy recommendation. I'd say 1, we anticipate a stable core business for Apple in the foreseeable future. So once again, it's the iPhones, the Macs, the iPads, and we think that's going to help drive 180 to 200 billion in free cash flow here over the next 3 years, which will help kind of leverage them into other potential addressable markets or returning it to shareholders. But at the end of the day, when you look at that business, we expect it to be stable, and we do see opportunities, whether it be 5G, whether it be the potential for a foldable phone. By the way, Samsung will announce we expect to unveil a foldable phone by the end of this year. If there's strong traction for that, we do think there's the potential for Apple to go into foldable phones at some point. But overall, that's the first key driver we think to Apple. We think the second point to our call, services wearables, we think will continue to drive multiple expansion in the shares. Once again, we expect services growth to eclipse north of 20% here over the foreseeable future. We do expect a video streaming service to be announced, which could act as an additional catalyst. But overall, as Apple kind of starts rolling into more reoccurring, higher margin type businesses, we think the street will provide a bigger multiple to the shares. And then finally, of course, is that cash return program, which we think will continue to prop earnings growth and provides downside support to the shares. But when you kind of look at the consensus estimates here going over the next 2 years, we think the consensus continues to underappreciate that cash return program going on with Apple. Just a quick note, though, for those that didn't see, we did increase our 12-month target price this morning on Apple to $255 from $230. And that really wraps it up on my end. I'll now pass it back to Zach.
Angela, thanks for that presentation. As we draw toward the end of the session, I'd like to remind our viewers that Angelo's work represents just one of the lenses through which CFRA views a company such as Apple. He's referenced that a few times, but in terms of CFRA's work, we've also done some groundbreaking work on Apple from a forensic accounting perspective. If you look back a few years, we were able to correctly forecast a 200 basis point margin deterioration a few years ago. In addition, Angelo also referenced our legal edge work, which focuses on identifying asymmetric risk opportunities in the market from legal risks in particular. Our legal team combines some deep legal and regulatory experience with time on the buy side to understand exactly how investors view situations and where some unknown risks to the market may lie. If you haven't seen that work, please take some time to take a look. With that, I think we're going to turn to questions from our audience. As a reminder, you can submit questions using the chat function. We did have some questions submitted before the webinar even began. So I might lead off with those and turn it over to Angelo one at a time. First question we got before the webinar, Angelo, was, in the past, Apple's provided announcements at this event that have surprised investors. In your view, do you see anything coming from Apple that could act as an additional positive catalyst to the shares?
So, when we kind of look at this here, I mean, it's really hard to see anything new on the hardware side of things that we think would surprise. Although Apple tries to do something here on an annual basis. I mean, last year, they did give us a sneak peek on AirPower. Unfortunately, it was way too early and it still hasn't come out. We think, if there's anything they can do to maybe surprise, it would be potentially, giving us a sneak peek on maybe a video streaming service, which would be a huge catalyst. But personally, we don't expect that to be seen until their developers conference in June of 2019. I think, something else that could potentially surprise is maybe on pricing. I think all eyes are really going to be on pricing for these phones. I think if Apple somehow keeps that price point for that iPhone XS, which is the second iteration of the current iPhone X, if they keep that price point at $999 and they price that Plus version at $1,099, that I think that provides upside to potentially numbers on the street. So I think keep a close eye on the pricing side of things, which could help improve sentiment on the shares.
Okay. Second question we received is, what suppliers do you view as being most at risk or having the most to gain in future Apple product cycles as opposed to the current one?
Yeah, so in terms of who has the most to lose, I mean, at this point it's a company called Cirrus Logic. They do have about 75 to 80% of their sales going to Apple. So of course, lost business to Apple would absolutely annihilate this company. But that being said, we think that's very unlikely, and we do have a buy recommendation on shares. We do think that they're more likely a winner than anything if you see that the noise cancellation feature on that AirPod. Again, probably 2019, but you may see it next week. And I'll say in terms of who else has the most to gain in the future, we think it's some of those RF companies, those connectivity plays, whether it be Qorvo, which we really like, Broadcom, as well as potentially Skyworks, which we have a hold recommendation on, as well as, and the reason for that being is we do think you're going to have to see significant content gains on the RF side, especially as we move to 5G. And then, of course, Qualcomm, which really at this point has nothing to lose and everything to gain, as we kind of highlighted before.
Okay, I think we've got time for one more question. So I guess the ones that are remaining, the one I choose is, with so much discussion about 5G rolling out in 2019, with initial smartphones from major competitors being announced next year, why is it that you don't expect a 5G-enabled iPhone until 2020?
Yeah, no, so that's a good question. So, when we look at things here, we do expect potentially Samsung to roll out a 5G phone as early as April of next year with their Samsung S10 device, I guess it'll be at that time. We also expect Huawei, which is the number 3 smartphone player out there, to also announce a 5G phone in the first half of next year. But that being said, when you kind of look at how the 5G market is going to be constituted next year, we don't expect more than, we expect about 3% of total mobile subscribers to have 5G access in the U.S. in 2019. And, when you think about that, there's really no need for Apple to rush for a 5G device, as most people won't get any use out of it. At this point, we think Apple is really looking to kind of keep costs low on their end. And by moving to a 5G device, it probably increases costs that they don't want to increase on their end. So we think the most likely scenario is that they wait till 2020 for them to really ramp up on a 5G device.
Okay. We've already run over a little bit for today, so I think we'll take the time to wrap up now. I want to remind everyone that our next webinar, Technology Platform and Legal Risks, will take place on September 12th. You may notice that also includes Apple as a subject of discussion. We'd love it if you could register and join us for that webinar if you haven't done so already. But for now, on behalf of the team at CFRA, we'd like to thank everyone for joining us. Within the next day, you'll receive a note from us with a link to the replay and slides from today's session. We'll hope you will join us again for our next webinar. And in the meantime, if you have any questions, please don't hesitate to contact us at cservices@cfraresearch.com. Thank you all for joining.